Hello, everyone. Welcome back to Current Economy and Investment Insights that Paul is going to be helping us with. And Paul, of course, is from Ameriprise Financial. Today being September 14th, 2020, the day after Grandparents' Day, Paul.
Happy Grandparents' Day.
I'm waiting for a response from Paul. Paul, you're not in that category yet. Anyway, Paul, you're going to give us an update of what took place in the marketplace, and then I will give the information that was shared with us from Ameriprise as of this morning.
I do want to say Happy Grandparents' Day to everyone out there. It seems like every day is a different, I call them Hallmark holidays, I think, nowadays.
Yeah.
And I don't know what day anything is. I'm just happy to remember my anniversary and my wife's birthday, and
Those are
we'll go
important.
from there. All right, let's begin. We're going to talk about jobs today, and the demand for workers is showing a strong recovery. The U.S. economy still has a long recovery road ahead. However, businesses and workers are both showing confidence in the recovery's prospects via strong labor demand and a sharp jump in the number of people quitting their job. Labor Department studies have shown the majority of people that quit their job to do so for a better position. The quote-unquote quit rate also tends to rise when people have confidence in the job market. Last week's jobs opening and labor turnover report from the Labor Department showed 6.6 million job openings across the U.S. economy in the month of July. The level was a strong 617,000 higher than June, leaving total job openings down just 386,000 from their February level of 7 million. Meanwhile, the jobs opening rate, now that's the number of openings relative to the total employment, has also registered a strong rebound in recent months. July's rate of 4.5% was actually stronger than its levels just prior to the pandemic, and it was just 0.3% off its all-time high of 4.8% as last reached in January 2019. So all good news so far to report on jobs growth and jobs production that could tend its way to improving the economy and just all around people in better moods, spending more if this continues.
Oh, I guess that's what's going to happen. If the economy keeps increasing, the Dow eventually is turning around. NASDAQ, as you know, is a blockbuster for the past several days or week or two. It kind of motivates people to go out to the retail store and buy things and
Exactly.
get the economy moving.
Hopefully, and all the numbers we report, as I just did, they're outdated, they're old, but they're the newest numbers we get. So hopefully we have no major shutdowns to derail this again, and we can keep people wearing masks and doing the right things, whatever that may be, to keep this in check.
Well, thanks to Ameriprise Financial in supplying us this information as of this morning. Domestic equities are higher by 1% on renewed optimism regarding a potential vaccine before the year end. Any comment, Paul?
I mean, that would be great. That is a highly debated topic. Will it be done? Will it not be done? All I know is we're making progress. So even if we don't have it by the end of the year, it seems like the drug companies are advancing and getting closer. So that's good news.
Right. And to move on to stocks in Asia, ended higher with most major indices up just under 1%. Korea was the standout, up 1.3%. European indices are trading mixed at midday. And the U.S. dollar is weaker versus the yen and euro, while gold is up 0.1%, and WTI crude oil is trading 0.2% lower.
Yeah, it's good to see the global economy recovering. We always say it's a global economy. It's been a global COVID pandemic, so everyone's going through similar things that we're going through. Let's all get better together, right? That's what we're hoping for.
Exactly. Nvidia is higher pre-market following a definitive agreement to acquire ARM Holdings for $40 billion. And that is the information as of this morning. I want to talk about the year-to-dates. that the S&P, Dow, and Nasdaq are. The S&P 500 is a +4+%, and the Dow is a -1+%, and the Nasdaq is a +21 plus some change percent in all year-to-date percentages.
Yeah, again, a significant outperformance in those NASDAQ stocks over the Dow stocks, but that's the way it is. You never really know what you're going to get in any given year, which indices are going to outperform. This year, for the most part, all year, it's been the NASDAQ stocks.
You know, we talked about last week, it was ironic, we said that the market was doing well and all this, and that there could be a correction. Do you know by the end of the day that we went on the air, it fell, I don't know how many hundred points it fell,
Yep.
the Dow did rather. It's ironic because the market is so volatile at this point. True, it's been up a lot, but it could take a downturn depending on politics.
Yeah, and I think last week's show, if I'm not mistaken, was the first time you had reported a positive Dow since the pandemic in February and March.
Right.
And of course, just like you said, not even a
minus.
week later, we're back down to a minus 1% and some
Yeah.
change.
Yeah. Okay, Paul, thank you for your report. Paul will be back in a little bit. Stay with us. We're going to be talking about your money, election impact on the market and investments. And stay with us. We'll see what Paul has to say. We'll be right back. And we're back with our program called Your Money, and thank you for staying with us. And we try to focus on a particular topic, and Paul today has a topic called the election impact on the market and investments, and we're going to let him roll with that. Paul, take it away.
Thanks, Ron. You know, anyone that's been watching the news, really at any point this year, we're well aware there's a presidential election this year, and it's going to be a highly debated one. So I get the question a lot on what is the election's impact going to have on the stock market and my investments. So that's what we're going to talk about today, and let's go ahead and get started. As we approach election day, investors are understandably wondering and even anxious about how the U.S. presidential election will affect the stock market. Elections years often come with increased market uncertainty, and this year, COVID-19 and a fragile economy have added a new dimension to what may be a landmark U.S. election cycle. Regardless of who ends up winning in November, the election will likely play a factor in the markets. So let's go over a few things investors should consider. Number one, how you deal with uncertainty. This year's election season has been marked by unusual circumstances. Republican incumbent President Trump is running for a second term after a surprise victory in 2016, whereas former Vice President Joe Biden began the campaign season competing against 25 other candidates for the Democratic presidential nomination before emerging as the party's nominee after a bit of a rocky start. There are many important issues at stake, including trade, healthcare, tax policies, social justice, and our relationship with China. How well the economy is doing is also a significant influence on the election's outcome, especially for an incumbent or incumbent party. But that calculus has suddenly become clouded by the onset of COVID-19 pandemic. How long the virus will persist and how significant the impact on the economic growth remains unclear at the moment. Even without these unusual circumstances created by the pandemic, it isn't uncommon for the stock market to exhibit a degree of volatility in the run-up to an election. This can be particularly true in the final weeks leading up to the election and if the race seems to be close. Investors should be prepared for circumstances where the noise generated by the campaign contributes to market fluctuations. It's not just the president. It's true that our president has tremendous influence in the direction our country takes. However, it's important to keep in mind that regardless of who is successful in winning the White House, there is a significant difference between proposals and policy. How much any administration can accomplish is influenced quite heavily by the makeup of the House of Representatives, the Senate, and also state and local legislation. Federal regulators, as well as circumstances in the economy and the country at large. In addition to electing a president this fall, voters will also be electing 35 senators, now occupied by 23 Republicans and 12 Democrats. Currently, the Republican Party has a 3-seat majority in the Senate, and as happens every 2 years, the entire House, where the Democratic Party currently controls a 35-seat majority, is up for re-election. Let's look at if history is a guide. So while no election years offer the same economic or political circumstances, it may be instructive to look back to see how markets have performed in past as a means of providing some context for the present. So I've got a couple of points to go over on past elections. Let's look at point number 1. Historically, market volatility begins to rise about 45 days ahead, or roughly 3 weeks into September, before peaking 1 week before the election. Again, this is just general history on this stuff. Point 2, in instances where control of the White House changes parties, stock market volatility tends to increase. Point 3, during an election year, U.S. stocks and bonds tend to perform better compared to the year after. Point number 4, increasingly there has been very little difference in the performance of the economy under a Democratic and Republican presidents. This is back since 1977. According to recent analysis by Deutsche Bank, the average growth rate for a Democratic president is 2.9% compared to 2.7% for a Republican president. However, it is acknowledged that the economic performance during a president's term isn't necessarily a direct result of the actions their administration took, as presidents ultimately inherit an economy shaped by their predecessors' actions as well as other structural factors. That may be a more important consideration for investors than who is elected president. Are the longer-term drivers for economic growth and corporate profits, which are shaped by policy, but also other factors outside of Washington. And finally, 2 last points or topics I want to cover. The impact on specific market sectors. Although it's speculative to try and predict the outcome of the election and all of the policy implications that party would impose, the result of the election is likely to influence key industries. Among the sectors of the market that could be affected in different ways are always, we look at healthcare, energy, and technology, depending on the results of the election. And last but not least, what does all this mean for your finances? While it's natural to think about the impact of the election on your investments, it's only one factor. Stay tuned for the bigger picture of your long-term goals. Review your portfolio, diversification, and risk tolerance with a financial advisor for an objective perspective on your financial situation. And if you don't have a financial advisor or are looking for a second opinion on the person you are working with, feel free to give me a call directly at 708-226-3412.
Paul, that was a great summary of the history of the market and what happens and the timing of that. That is really cool to hear all that.
A little long-winded there. I know this show ran a bit longer, but there was a lot to try to include. It's a lot of generalities on what's happened in the past, and it also depends on what time frame you take.
Right.
Like a lot of that data I gave you was from 1977 to present day till present day. If you traced it back to the 1960s, the numbers would look different. To the 1950s, the numbers would look different. So anytime someone's giving you statistics, look at the time period they're giving you those statistics from.
Very interesting. Paul, thank you for that. I want to thank Ameriprise for also giving us and sharing with us the last minute information that we do on the current economy and investment show as well. Appreciate that. Great topic, good information, good summary. Thank you for
Thanks.
that. For Paul Munical with Ameriprise Financial and myself, Ron Jankowski with Channel 4 and Palo Sites, we wish you good investment day.